All right. Hi, everyone. Thank you so much for joining us today. We've got a lot to cover, and so I'm just going to jump right in and get started. My name is Cece Mortar. I'm the programs manager for the Steamboat Springs Chamber. I want to start today by giving a quick shout out to our business education series sponsors, Mountain Valley Bank, UC Health, Northwest Data Services, Air Academy Credit Union, and the Colorado Housing and Finance Authority. They help us make these events possible. So yeah, thank you. A couple of house cleaning items. Please switch your chat to everybody so that everybody can see your chat. We'll also be taking questions throughout. There'll be a couple stopping points, but please feel free to type them in right away so you don't forget them as you have them. And use the Q&A function at the bottom of your screen if you can. I'm excited today to introduce Jessica Copy. She's a local financial advisor with Edward Jones. She's a seasoned finance professional with over 13 years of experience in the industry. She does a lot of work with us and with United Way and some other entities in town. And her goal is to equip individuals with practical tools and insights to achieve financial success in both budgeting and investing. We couldn't be happier to have you today, Jessica, and I'll let
Thank
you
you.
introduce your partner, Dave.
All right. Well, that was the best introduction ever. So thanks, Cece. Like she said, my name is Jessica Copy. I am a financial advisor up here in Steamboat, and I've been with the firm for about 13 years. So our mission and our branch is to bring the human touch to the world of personal and business finance. And one way that my branch office administrator and partner, Amy Ibarra, and I have found to accomplish this is providing education to our community so that everyone can move forward making sound investment decisions empowered by knowledge. So at Edward Jones, we are fortunate enough to partner with some of the largest mutual fund managers in the world who do help us provide education and timely information to our clients and those in our communities. Today, I am thrilled to have Dave Owens from John Hancock Investments here to talk about smart investing moves and considerations for the world we find ourselves in. Dave has been with John Hancock since 2005 and has been in the financial services industry since 2001. He is passionate about both the markets and educating others about investing. So with that, I'd like to welcome Dave to speak about 9 things every investor should know and where you should begin and how to focus on your long-term goals. Take it away,
Terrific. Dave. Thank you, Jessica, and good morning, everyone. Today, the agenda looks as follows. I have about 35 to 40 minutes of prepared comments. Throughout the presentation, from time to time, I will pause. I'll ask Jessica if there are any questions or comments in the chat box. Please feel free, as Cece mentioned, to go ahead and submit those questions as soon as they come to mind so that you don't forget them. Also, at the end of my comments, we will open it up for additional Q&A. But we like to have this interactive if possible, so I will go ahead and get started and pause after a few minutes and see if Jessica has any questions. So I'm going to take it away. Again, as she said, there are 9 different ideas here. As the screen says, it's time-tested strategies for today's investors. These are not strategies that are just recent. They're not things that we've come up with in the last couple of years since COVID. These are things that have been working for investors for multiple decades, going back close to 100 years. And so what we'll start with is just quickly looking at these 9 things. I'll read them quickly because each one we will highlight along the way. So investing may help your savings catch up to your financial goals. Investing in U.S. stocks is one of the best ways to build wealth. International stocks can help you cast a wider net. Bonds may offer a more stable foundation. Here's one that I think is interesting. Actually, I mean, they're all interesting, of course, but this one I think is unique. There is no wrong time to invest. Diversification is a time-tested way to help mitigate risk. Active and passive strategies can play a role. Your emotions can be your worst enemy, and your financial professional is your greatest resource. So starting with investing, if you look here at some of your life's financial goals, and I'm one of 6 children. My parents did not have enough money to help pay for college for all 6 of us. So many of us in my family ended up getting student loans. However, I do know that many families want to do their best to help cover their child's cost for college. And what's interesting is you can see that this is not the cumulative 4-year cost, the average annual cost. So you think about it's somewhere between 45 and 57,000. Let's just round it to 50,000. That means over a 4-year period, it's about $200,000 to go to college all in. A middle-class child born in 2022, to raise them to age 18 is almost $300,000. And a single year in retirement, on average, is almost $70,000 a year. These financial goals and things that need to be covered most likely cannot be met, those obligations, by just savings alone. And so what we have here, and you may have heard of the rule of 72, and it says, how many years will it take for you to double your money? So you take the percentage of return and divide 72 by that, and it'll show you how many years it'll take for you to double your money. So now we all probably, maybe not everyone, but most of us are probably aware that cash and money markets are paying more than the long-term average. Today, they're somewhere between 4 and 5.5%. The long-term average is about 2.2. And at some point in the future, cash, money markets, and CDs will no longer pay the yield or the return that they are as interest rates decline whenever that time comes. What this is telling us is that if you just saved, it would take you 32 years to double your money. However, investing in US companies, as you can see on the bottom right, the long-term average return is 9.4% per year, which means that you will double your money in 7.7 years. Now, think about that for a moment. 7.7, if you multiply that by 4, that's almost 32. So in the 32-year period for savers that it takes for them to double their money, you will double your money 4 times. Now, you might think that that means $100,000 goes to 400. It actually is much greater than that, because you start with 100,000, you double it in 7 years, you now have 200,000. Then over the next 7.7 years, you double it again. So now you're at $400,000. And then the next 7.7 years, you double it again to $800,000. So that is an example of compounding, and I'm going to show that to you here in a moment. So reinvesting your interest, for example, that, I'm going to go back one. If you doubled your money in the stock market over 7.7 years, that is the interest that has compounded. So now you have $200,000 to invest. And as I mentioned, then it grows to 400. Now, if you did not reinvest your interest, you would have 100,000, you would double it. Now, if you just reinvested the initial investment, that would only be 100,000, and you would double that again, and you would have $300,000 instead of 400. So the whole idea of compounding is, as you put money into investments and it grows, you continue to reinvest not only your initial investment, but also the money that you've made on investing. And that compounding has huge magnification of returns over time. Before I move on, Jessica, I'm going to pause to see if you have any comments about this or any questions.
No questions at this time.
Great, thank you. So let's talk about investing in stocks in the United States. As you can see, it says stocks have outpaced bonds and inflation over time. However, there has been a lot of volatility along the way. And this here goes back to 1982. And if you look at 1982, it talks about unemployment hits 10%. Now, think about that today. If unemployment is at 3.5%, that means that unemployment would almost triple. And that, for a short period of time, was quite meaningful and devastating to the US economy. However, the US economy and the stock market has a history of recovery. and adapting and adjusting. And so along the way here, you've got about, I don't know, 15 to 20 major issues and sometimes a massive crisis that had a meaningful impact on not only the economy, but also the stock market. And I'm going to highlight two spots here. If you look here in the year 2000, that's when the tech bubble burst. Many of you may remember that. And so from 2001 and 2002, the stock market declined by about 50% over that period of time. You had multiple things take place. The tech bubble burst. You had 9/11 take place. And then you had the biggest bankruptcies in history in 2002 with Enron and WorldCom. Many investors said, I can't take this any longer. And they moved from stocks to cash, which I understand emotionally. It makes people feel a little bit better about that. However, those that stayed the course were able to recover all of those losses and then some. However, we also went through the 2008 Lehman Brothers bankruptcy and the housing crisis in 2008, 2009. The market again was down about 50%. But what you can see is that those that stayed the course back here in the year 2008, when the portfolio was worth about $1 million at the time, that's what that shows. Again, it dropped to about $500,000, and many people felt like the market will never recover. However, what happened is if those that stayed invested, and this is the S&P 500, that $500,000 would now be worth about $6.7 million today. So one of the most important things for individuals to understand is that the stock market, volatility comes with the stock market. And we'll show a few other examples of that in a moment. But if you have a goal and an objective and you stay that course, historically it shows that you will be handsomely rewarded for staying invested. So what I like to show is that the stock market, as you can see, from 1928 to 2022, almost 75% of the time, the years are positive. So on average, 1 out of every 4 years, the stock market will have a negative return. Those odds are very attractive, knowing that 3 out of 4 years, they tend to be positive. And what's nice to see is that you can notice that you have 21 times it returned between 10 and 20%, 16 times between 20 and 30, and 13 times between 30 and 40%. So you add that up and you can see that you have 40 periods where the market returned between 10 and 40% per year. Long-term averages of stocks are about 9% per year. But historically, the stock market doesn't have a calendar year that aligns with the averages. The stock market tends to be a market of extremes because an average is, again, it's the average of all of the different periods of time. So what I think about is the good news is if I stay invested, I know that typically 3 out of 4 years are going to be positive. And those positive years actually tend to be greater than the long-term average, meaning they tend to be greater than 10%. Now, this talks about 10 years. How often do you have a negative 10-year return? Well, as you can see, 5 times in 86 years that's happened. So on average, more or less, 1 out of every 20 years, you will have a 10-year return that's negative. Now, if you look over here, there were 5 10-year periods that were negative. The 2 most recent, 2008 and 2009, the S&P 500's 10-year return was negative 1% per year. So frankly, it wasn't an annualized return of negative 8 per year or negative 7 per year. 2008 and 2009, those 2 10-year periods were more or less flat. But what you can see here is as you go further to the right, the likelihood of you having a 10-year period of annualized returns over 10% is very high. So the longer that you hold stocks, the greater your odds are of having a positive return. Now, what a lot of people don't realize is that years that are positive can also feel painful. And that blue bar shows the intra-year decline. What does that mean? That means that during that year, at some point, the market sold off and was negative. And the green bar is the actual return. So let's go all the way over here to 2020. What you can see is that during the year in 2020, there was a period of time where the stock market was down about 35%. That felt very painful at the time. If we look back at history and we just look at calendar year returns, we say, oh, 2020 was pretty good. 2020, the market was up 18% for that year. But that just shows where the market ended. How did the investor, what was the person's experience in the market during 2020? Well, there was a period where the market was down almost 35%. If you had $100,000 invested, that $100,000 would have turned into $65,000. However, that $100,000 investment by the end of the year was worth almost $120,000. So markets will often experience these setbacks, but historically they tend to move higher. As I mentioned, on average, 3 out of 4 years, the market is positive. But if you look at this, very few periods, and it looks like it was 2017 and 2019, those were the only 2 years, if you look back since 1982 or 1983, that the market did not go negative at any point during that year. So that is extremely unusual to have a positive performing year throughout the entire period from January 1 to December 31. What about stocks outside the US? So a lot of people are not aware that we tend to use products and services from companies that are based outside of the United States. And if you start at the bottom left corner at 7 a.m., many people use Nestle from Switzerland for their coffee mate creamer. And at 8 o'clock, maybe they jump into their Toyota and drive to work. Some have a Samsung phone. Others, they might have an Apple phone. I'll tell you right now that I am presenting this on a monitor that's from Samsung. So many of us are using products outside the US for our technology and media. At 1 o'clock, you have the ATM. Some of you might need to take some aspirin at 3 from Bayer in Germany. You go to the gas station from Shell in Netherlands, and you might want to unwind with a Budweiser beer from Anheuser-Busch. So these are all high quality, broadly diversified companies that many times can help supplement the US positions or equities that we have to provide a little bit additional diversification in our portfolios. It also talks about over the last 10 years, the world's best equity markets have typically come from outside the US. Now, we at John Hancock do not promote investors to try and find which country they should buy each year. Because historically, we know if we try and move our investments in 2011 and we go into 2012 and then we try and figure out which country is going to do the best, how many of us are going to choose the country of Turkey? Well, the likelihood of that happening is slim to none. And then in 2012, going into 2013, you move from Turkey to Greece. Well, you may remember that Greece, just 2 years prior in 2011, that was the European debt crisis where the country of Greece looked like they were going to default on their debt and go bankrupt. Many investors stayed away, as far away as they could, from investing in stocks in Greece. However, 2 years after that potential bankruptcy of the country, where they were on the brink, they ended up being the best return out of all countries in the world and outperformed the S&P by a full 20%. What we do recommend is for individuals to talk to their financial advisor about what type of exposure or investment they should have in countries and companies outside the United States. And what we've seen over time is by properly diversifying our investments into high quality portfolios outside the US, we tend to be rewarded over our lifetime of investing. So this also talks about the global market capitalization. There is something called home country bias. And what that means is that any individual tends to overweight their own country in their portfolio. So investors in England tend to have most of their investments in English companies. Now, here in the United States, we make up about 60% of the total global market capitalization. What does that mean? Well, when you look at all of the stocks around the world and the value of all of those stocks, stocks and companies in the United States make up 60% of the entire world. However, most people have 73% of their portfolio in the US. So that is 20% higher than the globe. Now, it has been beneficial for investors and people to put more of their portfolio in the US over the last decade. As we've seen, the United States has been the best place to invest over that period of time. However, things are cyclical and leadership changes. And what we saw more or less from 2000 through 2012 is that international stocks meaningfully outperform US stocks. So there will be change in leadership at some point, and we want to make sure that our portfolios are properly allocated so that we can benefit from those areas of the market. I'm going to pause here. Jessica, any questions or comments from you or from the audience?
No questions from the audience. I do have something to add, but I want to add it when we talk about timing the market. So
terrific. Sounds good.
In.
Okay. So what about bonds? What is a bond? What does it do? Now, if for those that are unfamiliar with bonds, bonds are a debt instrument that a company or a municipality will issue. And they will issue bonds at $10,000. And they'll say this is a $10,000 bond or a loan that will have a 10-year maturity and will pay you 4% every year until it matures, and then we'll pay you your entire money back. Now, sometimes bonds sell at a discount. Sometimes they sell at a premium. This example is showing the $10,000 bond selling at a 15% discount to par. Par is what it initially comes out to the market. So $10,000 at a 15% discount is $8,500. That is the blue bar all the way to the left. And what you can see is that you are paid $200 along the way. The total income you get is $2,400 over a 6-year period, which is a cumulative return of 46%. And at the end, you are paid the entire bond back, meaning it matures. And that investment of $8,500 that you initially placed, you will in the end get paid $10,000 plus the remaining coupon or income of $200 there. So they tend to have a nice stable return. You get this regular cash flow or income plus the return of your initial investment. And if you buy that investment at a discount, you get the additional return back to par. So very quickly, we'll just go over some different types of risks. You have interest rate sensitivity and credit sensitivity. What does that mean? Well, interest rate sensitivity means as interest rates rise or fall, it will have a meaningful impact on these types of bonds. So if you have treasury bonds and interest rates go up like they did in 2022, that was very challenging for the US government bond market as well as municipal bonds. As interest rates fall, meaning they go from higher yields to lower yields, that tends to be very attractive for government and municipal bonds. What you can see on the right is credit sensitivity. That means what is the quality of that bond and how sensitive is it? It's a little bit like if any of you have had your credit score given to you, whether it's the FICO score, and the lower your FICO score, the higher your credit risk is, meaning the bank or whoever will lend you money. If your FICO score is lower, they will tend to lend you money at a higher interest rate because of the credit worthiness, if you will. So high yield corporate bonds, these are also sometimes known as junk bonds. High yield corporate bonds are corporations that do not have the highest credit rating. They have a lower credit rating. Now, they are very credit sensitive, meaning if they have a tough time repaying their bond, they could potentially default. Now, they tend to be very low risk on the interest rate sensitivity side. So high yield corporate bonds, when interest rates rose in 2022, actually did quite well. So a balance of bonds that have very little credit sensitivity and other bonds that have very little interest rate sensitivity are nice to blend together to provide a smoother ride. And that's what this, yes, go ahead.
Sorry, can I jump in for a second?
You bet.
I have a lot of younger clients who I often talk to about bonds in their portfolios, and they are averse to them in this current environment because we've seen price depreciation in the bond world because of rising interest rates.
Right.
Can you speak to why, when the Federal Reserve pauses on raising rates and is looking to drop rates, bonds become more attractive historically for all portfolios?
Great. Okay. So what's interesting is that bonds over the last, I don't know, let's call it 50 years, have done exactly what they are supposed to do, right? They give you a coupon, they give you the yield, and the price of the bond doesn't move that much. However, 2022 was the worst bond market on record. And the reason is that interest rates went from more or less 0 to 5% in a very short period of time. Now let's look at the flip side of that. So last year in 2023, and 2023 is not on this chart, but a diversified bond portfolio in 2023 actually made about 7% because interest rates had stopped rising, the Federal Reserve had stopped increasing rates, and they had paused. So why then do bonds do well as the Fed cuts rates? The reason is that today, and I'll give you just an example. Let's say bonds today that are being issued in this environment are yielding 7. The Federal Reserve, the Fed funds rate is 5. Let's say bonds are being issued at a 7% yield today, and you buy those, and that is the coupon or the income that you're getting annually at 7%. As the Federal Reserve drops rates, new bonds that get issued will be issued at lower rates because the overall bond market and the Federal Reserve Fed funds rate is lower. So again, let's say today a bond was issued at 7. In 6 months from now, that equivalent bond is being issued at 5. Your 7% yielding bond is worth so much more than that 5% yielding bond. So what happens is investors are willing to pay more for the 7% bond in a 5% bond world. So when you can buy bonds at higher yields to start and yields start to drop, the bonds that you purchase become more valuable because your starting yield when you bought it is much higher than the current environment that we're in today. I'm going to pause there. Jessica, is that the example you were looking for, or did I need to add something to that?
Yeah, so essentially you not only get the higher coupon payout, so you get your money reinvesting and compounding in that way, but also if you did want to go sell that bond, you now can sell it for more than you bought it for and more than a current bond is for. So you now also have price appreciation. So that's
right.
how you get increase in your portfolio.
You're right. It's a combination, correct. So you're not only getting the coupon or the income that the bond is paying you, but the value or the price of the bond goes up and you get appreciation. Meaning, if you remember, par, let's say, is 100, and that's what you bought, that 7% bond at 100. Well, if new bonds are being issued at 5 at 100, your bond that was issued at 7 at 100 is now probably worth 105. So now all of a sudden you make an additional 5% or 6% on top of the 7% that you're getting currently. Jessica, any additional comments on that before I go to the next one?
Not on that.
Okay, great. Thank you. So just quickly, this is showing the bond market performance over the last 20 years and that a diversified bond portfolio will smooth out the ride. The worst one is you can look at 2015 as a diversified bond portfolio underperformed the majority of other areas. However, it was a very tight year. The best performing part of the bond market made 1.15. The worst was negative 5.5, and a diversified bond portfolio was about flat. It was negative 0.7 for that year. So even though it looks ugly on the screen because it has a meaningful drop relative to other years on a diversified bond portfolio, it more or less was a flat return for the year. So how about there's no wrong time to invest? So as I mentioned earlier, I showed that chart of the stock market, all of the different events that took place, 9/11, corporate fraud, the housing bubble bursting, COVID, and so on. This goes back to 1940 and looks at different events that were considered a crisis. So the fall of France in 1940. The loss during that time was almost 17%. And if you look there 5 years later, the market was up 15.7. So what's interesting is that as you go down and look at different periods of time, now, by the way, the 1 year, that's the return, the cumulative return over 1 year. 5 years and 10 years are annualized returns, not cumulative returns. So let's go down to the collapse of Lehman Brothers and the housing crisis and the debt, they called that the debt bubble bursting in 2008. The loss during that event was about 40%. 1 month later, you were already up 18. 1 year later, you were up 50. You go out to 10 years and you annualized 15.8% per year for 10 years. That is way above the long-term average of the stock market. Now, if we go up one to the September 11th attacks, this actually was the worst of all of these periods. The reason is that September 11th took place on 2001. 7 years later, you had the collapse of Lehman Brothers. So that 39% drawdown during the collapse of Lehman Brothers is included in this positive 3.6 compounded return per year. So this decade, even though it was the worst of all, it still was positive. And during that decade, you had 2 unique major events that took place in that 10-year period. So now as we look over at 2020 for the COVID-19 pandemic, it'll be interesting to see where we are. However, the odds are in our favor that from the period of COVID-19 in 2020 until 2030, the markets should do quite well based on what the market has historically done after a major crisis. So this shows you what if you invested at a difficult time, right? So despite investing before a crisis, history has shown you will make money over the long term. So it's saying, what if you bought right before the market sold off? And so when you look at these periods of time, the oil crisis, it took a full 42 months to recover. But if you bought back in 1973 and the market went from $10,000 down to $5,500, over time, you still would have that $10,000 would have turned into $1.6 million. So if you look at a more recent one, you can see that if you had purchased during that banking and credit crisis, your $10,000 investment was cut in half. However, and it took 51 months to fully recover from that, but you still would have made 3 times your money. And this is showing you if you put your money to work at the worst time possible. Not the best, not an average period, but if you actually put all of your money to work at the peak. And the majority of investors do not do that. They put money to work as they have it. They contribute to their retirement plan or their IRA, or they just, as money comes along, they accumulate in what we call dollar cost averaging in. They put money into the market as time goes along. So this does show, yes, these short-term events, investing at the worst possible time, still you tend to do well over the long term. Right here just talks about missing the market's best days. So what's interesting is 20 years of growth of $10,000. If you had missed the 40 best days of the market over a 20-year period, your $10,000 would have turned into $7,700. That's how meaningful it is to stay invested over time. So I'm going to pause here for a moment, unless I've got one other chart. Well, this is more or less about trying to time the market. I'm going to pause for a moment, Jessica, and see if you had any comments or questions about it.
Yeah, so can we go back to slide 10, I think it is? It shows that 86 years with only 5 of them being down.
Yes, let's go
Okay.
back to it'll. If you'll humor me for a moment, I will go back to slide 10.
So I think that this slide perfectly portrays why it is important, in addition to those other slides, not to try and time the market. So as human beings, part of the behavioral side of finance is that we have a tendency to want to FOMO into things when they're going really well. And then we have a tendency to shy away from them when they are going really bad. So part of what, you know, a financial advisor or a financial professional in any sense of the word can do is try and help you avoid making those costly mistakes, because in 86 years, we've only had 5 years that have been down years. So if you're scared of entering in at the bottom, you're likely going to miss a great opportunity to come in. And if you think things are going too well and you don't want to enter in at the peak, you're going to be stuck in analysis paralysis, and you're likely never going to put your money to work. And again, goes back to, you miss those 40 best days and it significantly hampers the growth of your money. So just my plug for creating a strategy, having discipline, dollar cost averaging in if that's what feels good for you, but trying to turn off the emotional side of yourself that says now's not the right time because there will always be a reason for the because. That's just the way that our world works.
Right. So Jessica, I want to make sure, do we have on the screen elections on average? Do you see that there? Great. So what we see here is a lot of people ask me, well, what about the election? What about who's going to be in the White House? How is that going to have an impact? And what you can see, the second bar is an election year tends to be a very good year for the market. Actually, out of the 24 election years, only 4 were negative, and the average return was 11%. So in general, your returns on an election year are not only better than long-term returns of the market, but the odds of having a positive year are also greater. Now, when you look at, let's see if it'll, here we go. This shows you what the returns were for different parties in the White House. How did the market do under a Republican? How did it do under a Democrat? And much of it has to do with just when that president took office, what was the market doing at that time? So typically, the president does not really have an impact on market returns. So if you go all the way to 1929 and look at President Hoover, the return of the market was negative 82% during his presidency. He was elected right as the Great Depression started. Did he cause it? He did not. Did President Coolidge cause it? He did not. It was the market, it was the frenzy. And so what you saw is that you did have back-to-back Republicans. One had a cumulative return of 255%, one had a cumulative return of negative 82%. And frankly, neither of them had an impact on what the market was going to do. Companies in the current environment understand how to adapt to politics and what's happening not only in the White House, but in Congress. And many times when you have a split White House and Congress, that tends to be good for markets. So diversification is truly a time-tested way to get great appreciation, but because markets are unpredictable, as I showed you early, who is going to invest in the Turkish stock market in 2012? Well, there are many mutual funds and ETFs and investment options where they will buy some companies in Turkey and give you exposure there, but trying to time it tends to be a poor way to invest. What's interesting here is it shows, as I mentioned before, that 2000 through 2009, that decade, was very difficult for the S&P 500. And it shows you here that US large cap companies actually annualized negative 1% per year during that period of time. But many other asset classes and categories did quite well and generated additional return. Now, over the most recent decade, this chart wouldn't be the opposite, but it would look a little different. Large cap would probably be the best performing part of the market. Natural resources would be one of the worst performing parts of the market. However, high yield, tips, global bonds, loans, and so on would probably be similar to where they were before. So we never know which area of the market's going to do best over the next year or over the next 10, and that's why we want to be properly diversified. This just shows, yeah.
Two things. Can you explain what large cap is?
Yes.
Everybody would know what that is.
Okay, great. Thank you. So large cap, those are US companies that are the largest companies in our stock market. So those are not just technology or consumer staples, but you think about the largest companies in the United States. I think all of us know Amazon and Apple and Microsoft, but you also have JP Morgan, Johnson & Johnson, Walmart, Costco, and so on and so forth. So US large cap stocks are companies that are well known, are recognized, and typically people use them day in, day out, and sometimes they don't even realize that.
Okay, and question number 2, and this is actually from one of the attendees.
Yeah.
Because it is right in line with diversification. So the question is, why would an investor choose to invest in dividend paying companies versus non-dividend paying companies? And is it better to let the companies keep the capital for reinvestment, so not pay a dividend, or is the return generally better if they reinvest dividends to buy additional stock?
That's a great question. And what's interesting is that it depends to a certain extent on how that company is run and managed. So let's use an example again of Amazon. Amazon typically reinvests into the company to continue to grow, and that has benefited them meaningfully over decades. You also have companies like Pepsi that generate a nice dividend, and it also provides capital appreciation. So if you look at those two companies over a very long period of time, they tend to perform really well. Now, a dividend paying company historically has provided a little bit more, we refer to it as downside protection. What does that mean? Well, when the market sells off, many times investors move towards those dividend paying stocks because they historically, not always, but historically have been more conservative in nature. And investors know that they can get that dividend every quarter. They get paid income off of it. Whereas a company that reinvests everything is not paying income to their shareholders. They are focused more on growth and capital appreciation and growing the company. So there are a couple of things. Number one, dividend paying stocks and those that don't pay dividends, neither one is, you can't say this is good and this is bad. It really depends on what the individual who is looking at buying stocks or investing in companies wants to achieve. If you want to generate income and get that dividend from those companies, that is appropriate and suitable for your portfolio objective. If you're focused on long-term growth and don't need to receive dividends, then capital appreciation and reinvesting, and companies that reinvest in their own growth are terrific. We as a firm tend to recommend a combination of both, because over time you blend those two together and you have a much smoother return over time, and not as high highs and not as low lows.
And I just want to add on to that, as an advisor, we also, for our clients, will typically have a blend of both. It may just be skewed to the individual person. We may have more growth focused companies for a younger person who has a higher risk tolerance, but we still want that dividend to be paying out and compounding and reinvesting back in on itself. So you get that compound growth. For a person that is nearing or in retirement or later in retirement, we may focus more on dividend payers. So again, it goes back to personal preference, but I do think that that's a great question, Jeff.
Yeah, very good. Thank you. So we are a little bit short on time. It's 10:45, 10:46. So I don't want to minimize some of these other slides, but I do want to make sure we keep ourselves on time. Active and passive, a quick overview of this. This just shows you, an active investment is a professionally managed investment by a portfolio manager, and their goal is to outperform whatever their benchmark is. That typically is a mutual fund or an active ETF or an SMA, which is referred to as a separately managed account. On the right, you have passive. These are investments that just track the index, and their goal is to perform exactly what the index does. So why would you use one over another? Well, here are some of the benefits to each. On the active funds, it's really number two, is the potential for outperformance and some non-correlated sources of return. On the passive side, it's low cost, it's transparent. No person or team is key to the strategy's success, and it is a simple way to achieve market exposure. So 47% of financial professionals recommend a blending of active and passive approaches. We continue to see this as a way for individuals to get exposure to multiple markets and to have the overall cost of the portfolio decrease because you have a passive part. Now, what's interesting is 31% is all passive, 22% is all active, but the majority, almost half, say we like a blend of both. The nice thing about passive index investing, that's helped push down expenses across the board. So the individual investor has truly benefited from the passive market. Actively managed mutual funds, actively managed bond funds, their internal expenses, which come out of the return of the investment, have gone down meaningfully over the last 25 years. Again, this is that same slide as before, talking about the potential benefits of each. So the traditional index, they reward bigger over better. So what that means is the larger a company gets in an index, the more it takes up out of that index. The challenge is, if you look at March 2000 through September 2001, is that the technology sector, which made up such a big part of the index, well, during that period, it went down 61%. So sometimes the challenge is that these companies that get bigger, that generate performance in an index, if that index sells off, the biggest companies can tend to have the most detrimental effect. And so, as it says in that bottom right corner, too much of a good thing, because the S&P 500 index is a weighted by market capitalization, it can become overly concentrated in high-priced sectors. And that happened in the 2007-2008 financial crisis, where the financial sector was down 73%. So these are things just to keep in mind. As we get close to closing, emotions can be your worst enemy. It's natural to feel emotions about your investments. And frankly, we tend to make poor decisions when we are highly emotional. And I'll give you a personal example. So we're in the circle of trust today. So I'm going to share something with you that I might not share with everyone. And that is, I love my wife dearly. But there are times that I have said things to her that later on I wish I had not. And I'm sure that doesn't happen to anybody on this webinar. However, what do you think my emotional makeup was when I said that thing that I later wish I hadn't? I was highly emotional. If I had not been highly emotional, I probably would not have said that thing. Because by saying that, that was a bad decision. I regretted it later on that I had said it. And so if I had been calm and I had been thoughtful and I wasn't highly emotional, I would not have made that poor decision. So that's just one small example of how we are wired as humans, which means we can be our own worst enemy when it comes to investing. So this very quickly is showing that investors tend to leave the market just in time for it to start to recovering, and then they buy into the market after it has recovered because they feel good about getting back into the market because it's doing well. They get out of the market when it's doing poorly, and many times they get out of the market just in time for it to start getting better. So this just shows you that equity investors tend to jump around. Now, it may not seem like a big difference of 9% versus 9.8, but if you take 20 or 30 years and you get an additional almost 1% per year compounded over time, that is meaningfully additional dollars in your investments. So think about what your investment horizon time is. As you can see, over the last 10 years, it's been incredible. Over the last 25 years, again, think about all the things that have happened over 25 years. With the tech bubble bursting and 9/11 and corporate fraud and the housing bubble bursting, a lot of difficult things happened. But even through all that, the market still annualized almost 8% per year. Great years are not uncommon. What this shows you here is that the number of times since 1928, the market has had over 20% is 34. Now, if you remember, this is over 80 years. It's about 90 years. So you have about 1/3 of the time. So 1 out of every 3 years, the market does greater than 20%. 1 out of every 4 years, the market is negative. So it is more likely for you to get a calendar year return of above 20% than to actually have a negative year. And the final comment on this is that only 4 times in 94 years have you had a calendar year return close to the long-term average. So the market is truly a market of extremes. And fortunately, it's a market of extremes to the upside more often than the downside. So as we look here, I mentioned a moment ago that we can be our own worst enemy because we many times are making decisions based on emotions. When you work with a financial professional who is educated, understanding, knows how to help people stay the course, that is your greatest resource. They've been through it before. They help you stick to a plan. They know when you need to make an adjustments. And it does say they can help protect you from yourself, from sometimes making that decision of saying, I am out. And what I have seen time and time again, even with my own family and my parents, that their greatest resource and the way that they were able to retire with a nest egg that was meaningful to them was by having a financial professional help them stay the course and help them make the right decision during tough periods. The professional's value goes well beyond investments. This shows a brief list. This is a short list of probably only 1/3 of the things that a financial professional can do for investors. And I'll close with this quote: we don't have to be smarter than the rest. We have to be more disciplined than the rest. And with that, Jessica and Cece, I'll turn it back to you.
Thanks, Dave. That was great. Does anybody have any questions before we wrap up? I don't see any in the chat, but go ahead and put them in there if you do.
while we wait for questions, I just want to thank you both so much for being here. I think it was a lot of great information. And I will be sharing the recording out to the attendees this afternoon, so you guys can watch it again if you want. And if there are any questions that come up after the fact, feel free to send them my way and I can kind of help facilitate getting them answered for you. Yeah, I don't see any more questions coming in. So I just want to thank our participants. And again, Dave and Jessica, you guys were amazing. I appreciate all of your expertise. Thank you so much, everybody. Have a great
Thank
day.
you.
Thank you, Cece. Thanks, Jessica.
Bye.